Namaste. Good morning. In the last class, we started with the introduction of profits and gains of business or profession. We understood the chapter heading first. What does the chapter try to convey to us, or what is the nature of income it conveys? In this process, we understood that gain is also taxable. Not all gains. Some gains are taxable in this chapter. For example, when we look into section 28, compensation received for non-performance of a contract. For non-performance of a contract, we saw that this type of gain is taxable under this chapter. Though it's not recurring in nature, it becomes taxable in this chapter. So we understood the heading of this chapter first. Then we saw the split of this chapter, how this chapter is divided, or what are all the various parts of the chapter. I said, let's leave 44 for a minute. That's presumptive. Other than that, only two sections speaks about income. 28 and 41. Directly it speaks about income. Though in other sections there will be a reference, but generally. 30 to 37, 40, 40A are all, 43B are all going to speak about expenditure. I'll come to that very soon, about the stress of that expenditure. Then we started with section 28, the basis of charge. At that time, I was telling you that it consists of a list of items, list of aspects which are taxable in this chapter. PGBP, profits and gains of business profession. I told you about vocation in detail. Compensation received in this, the most interesting part is that compensation for assets and the Saurashtra Cements case law. Export incentives, in that I asked you to remember sale of import entitlement license, remuneration or interest to partners, income from trade unions, clubs and association, including institutions, value of any benefit or perquisite in the course of carrying on business or profession, and conversion of stock in trade to asset. These are taxable as business income. That's where we stopped in the last class. I'm just progressing from the same place. Like compensation, there is one other type of receipt I want you to understand at this level itself. It is not part of section 28, it is part of ICDS. ICDS stands for Income Computation and Disclosure Standards. Once more, Income Computation and Disclosure Standards, which are issued by ICAI. It's like accounting standards, similar to accounting standard, but it is for income tax purposes, the various modes of accounting. In that, ICDS 7 deals with subsidy, which is popularly known as government grant. In our accounting terminology, this is known as government grant. Okay. How to deal with this? If you look at accounting, it says what is the purpose of subsidy. If it is asset, reduce it from the cost of the asset and then provide depreciation, or proportionately charge depreciation and take it to income by a little memory of whatever AS12 is saying. But income tax law has a very different explanation for ICDS for treatment of subsidy. For treatment of subsidy. Again, the same question is asked for what purpose the subsidy is provided, but the nature of treatment slightly differs. Three falling branches. I am putting it as table. You are putting it as branches. Three falling branches. In case of depreciable assets. In case of non-depreciable asset, they are only speaking about land. General subsidy. Okay. In case of depreciable asset, non-depreciable asset, and general subsidy. Repeating, in case of depreciable assets, if the subsidy is for a depreciable asset, if the subsidy is for a non-depreciable asset, majorly or rather only land they are speaking about, and general subsidy. Okay, and general subsidy. What does this technically means, general subsidy? If I start an industry in a backward area, government provides me, let's take some 10 lakhs. Anybody who is starting an industry in some notified areas, the government is providing a subsidy. Let's take 50 lakhs. Okay. So what happens? So technically what happens? In accounting standard AS12, with my, as I told you, with my little memory, I am telling you, this is treated as capital reserve. I'm not exaggerating. This is treated as capital reserve in accounting. Whereas in income tax law, because it is the capital in accounting, the law says it is, the accounting standard says it is the capital contribution by government. But income tax law, in case of depreciable asset, subsidy needs to be adjusted with the cost of the asset. Subsidy needs to be adjusted with the cost of the asset, reduce the cost of the asset. I purchased a building for 1 crore, government gave me 20% subsidy, or let's take this popular solar equipment. I erected a solar equipment for a cost of 20 lakhs. Government gave me a 10% subsidy of 2 lakhs. Now the cost of solar equipment is only 18 lakhs. The cost of solar equipment is only 18 lakhs. On that only we can charge depreciation. So if the subsidy is towards a depreciable asset, it should be reduced from the cost of the asset to be treated as income, to be treated as income. In both these cases, okay, if the subsidy is towards a land under income tax law, remember, if the subsidy is towards a land under income tax law, this needs to be treated as income. If the subsidy is towards a non-depreciable asset, which is nothing but we are speaking about land, then the subsidy received should be treated as income. All general subsidies, income. Okay, under this note. Under this, a note. Okay, year of recognition will be either the year of due or year of receipt, whichever is earlier. The year in which you should treat it as income. The year in which you should treat it as income is the year in which you are actually receiving the subsidy, or the year in which you have fulfilled all the conditions for receipt. Shall I repeat? The year of recognition of subsidy will be the year in which you are actually receiving the subsidy, or the year in which it becomes due. Due here means I have fulfilled all the conditions. Now I am eligible to get the subsidy. Whichever is earlier. Whichever is earlier. Majority of the time subsidy is accounted on cash basis. So it will be year of receipt. Okay. Because on fulfillment they give. So whether we fulfilled or not depends upon government's grant. So practical that is, but generally on the theoretical aspect, year of a receipt or year in which fulfilled conditions are fulfilled, whichever is early. Okay, is this clear? Okay, before progressing into more about income, at this juncture, I want to also speak about classification of business. At this juncture, I want to also speak about classification of business. Speculative business, specified business, general, other than uh, speculative. Let's define it as general. Okay. Speculative business, specified business, general. Basically, we should understand the reason for classification. First question, basically, why should I classify? Why? Actually, I can give you an overview that this classification is not for this particular chapter purpose. This classification which we are making is not for this particular chapter alone. Then what is the need for classification? I take that answer. Yeah, one of the answers is nature of expenditure that can be claimed. Yes, in this case, yes. Set off of loss. That is the provision. First, let us understand what is speculative business. Transactions are entered into without actual delivery of goods. That is for a future transaction. A future transaction entered into today itself. Today you don't have the goods itself. I will speculate. Mentioned in section 35 AD. They have a list in section 35 AD. As that's what it said. If they have some special expenditures, etc., we'll understand that. Mentioned in section 35 AD. Other than speculative and specified business. So friends, speculative, specified and general, and as our friend was saying, it is more for the provision of losses. Loss can be set off. When I write set off, obviously carry forward and set off also. Because set off here, at least you will have some crosshead. Once you bring it to the next year, it can be set off only against the same income, one-to-one correlation, that head to that head. Loss can be set off only against income from speculative business. Okay, we'll see these things later, period, etc. and all. But as of now, I'm just giving you a bird's eye view of all these things. Loss can be set off only from income from specified business, whereas here loss can be set off, okay, loss can be set off against any income other than salaries in case of carry forward against any business income. Is the class clear? Okay. I am dividing business into three: speculative, specified, general. Its nature, the division, of course, I understand, is also for some expenditure related provision, that's very less. But basically, the division is for setting off of loss. Speculative loss only against speculative income. Specified business loss only against specified business income. Other than speculative, that is general loss, can be set off in the same year. It can be set off against any income, IHP, capital gains, except, whereas when you carry forward it, it can be set off against only business income. Only business income, but any business. So that's why this classification. Where are we in our classes? We understood what is PGBP. We are understanding section 28, the list of incomes, the prominent list of incomes. And also we understood subsidy, treatment of subsidy, that is more from ICDS 7 perspective, and classification of business. Before going into the case laws relating to income, before going into the case laws relating to income, I want to talk about one particular amendment. I want to talk about one particular amendment in Finance Act 2024. So this is not your year of amendment. It is amendment in Finance Act 2024. Amendment, a clarificatory amendment in Finance Act 2024. A clarificatory amendment was given by the government in the Finance Act 2024. Any income from letting out of residential property is taxable only under IHP and not under PGBP. Shall I repeat this clarification amendment? Any income from letting out of property for residential purposes. Suppose I'm having 10 property, or I'm having just 5 properties, and I am not doing any other work really like that, but not 5 properties. I'm not doing any other work. I have some 5 properties. I let them out and earn rental income. I let them out and earn rental income. Since I am having only one source of income, that is letting out of residential property, I am claiming it as income from business or profession. I am telling I am doing it as a business. Why I am telling so? Because I can claim many other expenditures. If it is house property, only 30% standard deduction can be claimed. Whereas if it is business or profession, I can claim all actual repairs, maintenance, staff salaries, if any, depreciation, like that. So I am claiming it as letting out of residential property as IHP, as business. The law has now clarified, if you have let out your residential property, I have a reason to highlight it. You will soon understand. If I have let out my residential property, it is taxable only under IHP and not under PGP. Not under PGP. Okay, friends? Okay. Okay. So this is a clarificatory amendment. It's in fact a clarificatory amendment in Finance Act 2024, which says any income from letting out of residential property is only taxable under IHP. So staff quarters will now be taxable only under IHP because it is let out to the staff for their residential purpose and not under PGP. Now I'm going into the next arena of our discussion, which is very important, interesting. Okay. Case laws pertaining to income. The next arena I am walking into is for our examination and for our financial year, what are all the relevant case laws? Basically, the case laws are subdivided into 3: PGBP versus IHP, PGBP versus capital gain, PGBP versus IFOS. PGBP versus IHP, PGBP versus capital gains. That is, when I say versus, assessee will claim it is taxable under IHP or PGBP as the case may be, and the department takes the other stand. So what does the code say? In which head? Similarly, capital gain. Similarly, other sources. Assessee takes one side. Department takes the no, this income is not taxable in the head in which you said. It is taxable in some other head. In that case, how this entire classification is going to work. That's what we are going to see. PGBP versus IHP, PGBP versus capital gains, and PGBP versus income from other sources. Well, to start with, the example I gave you, Watson has 5 house properties which are let out to various tenants. And I said, this is my only source of income. So this is taxable under PGBP. Income tax department said no, boss. Income tax department said no. It is taxable under IHP only by a clarificatory amendment. For Watson, fine. What about OYO homes? What about service apartments? They are also letting out for residential purposes. They are also letting out for residential purposes. Is the income earned taxable under IHP? In which case, these people run offices. These people have a lot of staff, security people deployed, watchmen, etc. And they provide a lot of amenities also. In that case, how to deal with it? Basically, you have to understand, class, please understand. Basically, you have to understand that this is a commercial let out. This is not to a single person itself. This 1 month or this 15 days, somebody stays. Next 15 days, somebody else stays. The same person does not stay. It is let out for commercial purposes, which is different from the residential purpose. Here it is an order. So, in a very famous case law called Chennai Properties and Investment Limited, in a very famous case law, Chennai Properties and Investment Limited, it was held that if these 2 conditions are satisfied, listening only, we'll write it. If these 2 conditions are satisfied, then it will be taxable under PGBP. This should be the main object. This should be the main object of the assessee. The primary object of the assessee should be this, and substantial source of income. 2 conditions are mentioned in the law. This should be the main object. What do I mean by that? This should be the main object. For example, my dear friends, in the object class, memorandum of association object class, this should be mentioned as the main object, or if it is the partnership, the main business. The deed should say that this is the main business. After all, I am drafting it. I can easily add it. But that alone is not sufficient. The law further says, if your profit and loss account has a total income of 1 crore, at least 51 lakhs should be from this rental income. At least substantial part of the revenue. Substantial always means, not only here, as the class goes by, you will see in many places, means 51% or more. Substantial source of income should be from this activity, from these should be from this object. If these two are satisfied, then the income is taxable under PGP. Okay, okay, right. Let's progress. Actually, there are three case laws for this. Let's write the three and then write the judgment. We go forward. I'm going into the first citation. Chennai Properties and Investments. Chennai Properties and Investments. Rayala Corporation. Rayala Corporation. Rayala Corporation and Raj Dadkar. I just refer the name. I want to speak about in these three case laws. Though you need not remember the other two, just remember Chennai Properties case law. That is more than sufficient. Okay. You remember the Chennai Properties case law. That is more than sufficient. Okay. In these three case laws, and majority of them are Supreme Court, especially Chennai Properties is a okay held by Supreme Court in Chennai Properties and Investment Limited, held by Supreme Court in Chennai, that if two conditions are fulfilled, then rental income is taxable under PGPP, is taxable under PGPP. Okay. Main object should specify, okay, letting out. Substantial income should be from such source. So, my dear friends, if these two objects are fulfilled, then that particular income will be taxable under this particular PGBP. Okay. So, as I told you, two criteria are essential. One, main object should specify letting out, and substantial part of the income should be from such source. If these two criteria are met, then it will be treated as business income. So this will lead you to a particular doubt. Sir, you said that letting out the clarificatory amendment said that any income from letting out of residential property is taxable only under IHP. Now you are, please understand, this is not letting out for commercial purpose, the residential, it's more of commercial purpose. It is understood that only residential purpose let out is taxable under IHP. If there is a commercial let out, it will only be taxable under PGP. NDR warehousing. NDR warehousing. NDR warehousing. So what are they into? Their main business is warehousing, storage of goods. Their main business itself is storage. So NDR warehousing is having warehouses where they store goods of company X, company Y, company Z. Apart from storing, they are doing small processes. What is that small processes like repacking, storing for security, ensuring that the goods are kept in a proper safe manner, like that they are doing. NDR warehousing. They received a rent. Assessing officer taxed the rent under IHP. Is that correct? No. No. Okay. Rent received on letting out of warehouse is, which is the primary business of the entity, is taxable under PGBP. Apart from letting out of warehouse, the assessee also performed ancillary services. So, okay, this is further proof that it is not taxable under IHP. Clear, friends? Clear? Are we understanding? Okay, we are getting the grip. Okay, nature of income. Now I'm going into the next set of case law, PGBP versus capital gain, Gujarat State Fertilizer Limited. Gujarat State Fertilizer Limited. Gujarat State Fertilizer Limited. Let's understand this case law before even progressing further. Okay. Fertilizers and chemicals. Okay. Before progressing further, let us try to understand this particular case law. My dear friends, I am a fertilizer manufacturing company. I am a fertilizer manufacturing entity. Okay, I'm a fertilizer manufacturing entity. I am eligible for subsidy. Government asked me to sell it at a lesser price so that they will provide me subsidy. Government is having cash crunch. So what they did, instead of subsidy, they gave me bonds. Instead of subsidy, they gave me bonds. From the top, I am repeating. I am a fertilizer manufacturing company. I am eligible for some subsidy because the government asked me to sell it at a lesser price. But government could not provide me subsidy because of cash crunch. So they gave me bonds in lieu, which means instead of subsidy. I sold these bonds and incurred loss. and claimed it as a business loss. I sold this, okay, I sold this bonds, I sold these bonds and incurred loss and claimed it as business loss. The question in front of us is it business loss? Because, my dear friends, because any loss arising through sale of bonds should be considered as capital. Once more repeating, capital gains chapter only deals with debentures and bonds. So sale of bonds and their income or expenditure loss resulting therefrom will always be treated as business loss, capital loss. STCL or LTCL, LTC. Now I claimed it as business loss. The case went to the court. The court asked, why did he get bonds? It is because in lieu of, instead of subsidy, he got bonds. Had he received it as subsidy, where will the income be recorded? General subsidy? Not towards a non-depreciable asset, or not towards a depreciable asset, general subsidy. It should have been recorded as income. Instead of subsidy, he received bonds. So, my dear friends, the court held the loss or profit is a business income. Business income or business expenditure. Where bonds are issued in lieu of subsidy, then income or loss arising from transfer of such bonds shall be taxable under business or profession and not capital gain. And not capital gain. Are you clear? Okay, right? Fine. K and Co. Very apart from Chennai properties, the largest number of tested in our examination is K and Co from the income perspective of it. Again, I want you to understand before progress. See, for quoting a tender, I need to provide bank guarantee. For quoting in a tender, I need to provide bank guarantee. For various other purposes, release of money, I will provide bank guarantee. Okay, duties or taxes, something are payable, I pay bank guarantee. So these are part and parcel of my business. These are part and parcel of my business. To provide bank guarantee, I need to make some margin money deposit with the bank. The bank asks for deposit, margin money. We call it as margin money deposit. The bank says, boss, you need to have a deposit so that I will provide you guarantee. Margin money deposit needs to be made with the bank to obtain bank guarantee. Understood? Understood? Legal, all of us. So we have to make some margin money deposit. Okay. And in this, I earn interest. From this, I earn interest. Margin money deposit from which I earn interest. Keep this on one side. Keep this on one side. I have done my business well. I have earned some cash profit, which I have not distributed as dividend. So there is surplus funds available with me, which I have made it as a deposit and earn interest. Now, the law, the court looks this into two different transactions. The court says, boss, in this case, it is closely related to your business. Without this bank guarantee, it is difficult for you to do the business. So this interest is taxable under PGBP, whereas here it is surplus. So this interest is taxable under IFOS. Okay, okay. In this case, it was held interest from margin money deposit for obtaining bank guarantee. Interest from margin money deposit for obtaining bank guarantee shall be taxable under PGBP as it is related to conduct of business. Interest on surplus funds invested is taxable on under IFOS. Is taxable under IFOS. Is the class understand? Are you all clear? You're clear, right? Margin money deposit. Very interesting again. Okay, very interesting. Okay, let's understand this particular case now. The company went in for issue of shares and received share application money, which needs to be deposited in a separate account according to company law. The share application money cannot be used unless the allotment is made. Only after completion of allotment, you can use this particular money. So it is kept deposited in a separate account. Once more repeating, it is kept deposited in a separate account. Share application money is kept deposited in a separate account from which I earn interest, from which the company earns interest. Okay, whatever is refunded, okay, without allotment because it has been oversubscribed. So I am refunding part of the application. I will refund along with interest. Whatever is allotted on this interest portion is there with the company. Whatever shares has been allotted, if the shares, whatever is refunded, along with interest, I refund. Along with interest, I refund. But whatever is allotted, the interest is with me. The interest is with me. Now the question in front of us is, there are some share issue expenses. Can I adjust it with this interest? Because share issue expenses is purely business. Purely business. Can those share issue expenses be adjusted with this interest? And the court said, yes, boss. Yes, you can adjust this. Because again, the deposit is not made due to my will and wish. Company law made me mandatory. And due to that deposit, I earned interest against which share issue expenses can be set off. Interest earned on share application money which are subsequently allotted is available for setting off any share issue expenditure. Interest earned on share application money, okay, because if it is refunded, it is not available to us, okay, is available for setting off any share issue expenditure. Okay, okay. So at this juncture, what are all the case laws we have so far seen? I just want to very repeatedly in PGBP chapter, I want to repeatedly tell this so that in examination and as the class goes by, you will keep remembering. In the first class on mutual concern, we had the Secunderabad Club case law, where one of the bank is a member, they kept it deposited, the bank gave interest. Will it come under mutuality? No, it will not come under mutuality because the bank is not paying in the capacity of the member, the bank is paying in the capacity of their business. Then in compensation, after we enter PGBP, in compensation, we saw a case, Saurashtra Cement, where the compensation is interlinked directly with an asset, then such compensation is taxable under, such compensation should be adjusted with the cost of the asset. Such compensation should be adjusted with the cost of the asset. Then these set of case law, Chennai Properties, Rayala Corporation, Raj Dadkar, K & Co, Sri Rama Multitech, Gujarat Fertilizers, which are directly linked with income. Please have a read through. We will proceed to the next level. Am I clear to you? Okay. Did you go through? Okay. So these are all the various things. Before winding up on the income discussion, let us also do some practical questions. How to answer? Please go to your practical notebook, write the chapter heading, business or profession, write the chapter heading, business or profession. Please go to your practical notebook, write the chapter heading, business or profession, and we will start answering them. specify the treatment while computing income under PGBP. Nature of subsidy received as a general contribution. According to ICDS 7, any subsidy which is not towards a depreciable asset shall be treated as income. Any subsidy which is not towards a depreciable asset shall be treated as income. Shall be treated as income. In the given case, it is subsidy of generic nature. That is to start an industry in a backward area, power subsidy like that. Okay. It will be treated as income. Okay. Shall I? Friends, the second. Subsidy towards construction of. It's a depreciable asset. It is a depreciable asset. Are you clear? So it should be reduced from the cost of the asset. Then subsidy should be reduced from the cost of the asset. Am I clear to you? Am I clear to you? Okay. Okay. Just a moment. Sorry, friends. Just a minute so that the when I give you the solution, it looks better. Okay. Okay. Right. Third, compensation received for income. Okay. Please understand, any compensation which is not towards an asset, because towards an asset we have Saurashtra Cements case law. Okay. This is part of law itself. Section 28. Non-compete fees. Let us understand what is this non-compete fees. Not participating in an activity. Let us take that there is a tender. Both me and Divya are quoting for this tender. Both me and Divya are quoting for this tender. Now, I tell Divya, you withdraw your tender, I will pay you some consideration for your non-compete. Don't think this is illegal, it's part of business. Don't have the assumption that this is illegal. No, it is part of business. So what Divya does is she withdraws. What Divya does is she withdraws. The consideration I paid to Divya is taxable under PGB. There are many software companies which enter into transactions where they say that in India, I will be the sole person who is distributing or the backend of this particular software. The company cannot directly compete with me. Adobe, I'm selling it. Adobe should not sell it. I'm just taking for example. I'm the one person, non-compete. There is an agreement between me and my principal company for a 10-year period. I'll use the collaboration of the principal company with a condition that after 10 years, they should not directly come into Indian market for the next 5 years. I should be the sole manufacturer, non-compete. These are popular terms, business aspects. Non-compete shall also be, okay, any consideration received for refraining from doing an activity. Any consideration received for refraining from doing an activity or not competing shall be treated as non-compete fee and taxable as business income. For the receiver, it is definitely taxable as business income. Following? Okay, okay, good. Sale of import entitlement license. Any export incentive shall be treated as business income. Any type of export incentive will be treated as business income. Once more repeating, any type of export incentive will be treated as business income. Will be treated as business income. Okay. Sale consideration of import entitled license is an export incentive. Clear? Good. Good. Payment received by a partner from the firm. Part of section 28. Any Paka? Is it clear? Okay, let's move on. Okay. Travel expenses incurred by the principal company for achieving target. Any benefit or purpose, whether convertible into money or not, shall be treated as business income. Liquidated damages received by a company for supply of plant and machinery for failure to supply within yes, Saurashtra cements, where the compensation, liquidated damages, where the compensation is directly linked to an asset, then it should be adjusted with the cost of the asset. Then it should be adjusted with the cost of the asset. Shall be adjusted with the cost of the asset, any compensation received. So, okay, the amount received will be reduced from purchase price of asset. Okay, purchase price or all other associated. Okay, okay, good. Right. Interest received on excess application money deposited in a bank, under what head it is taxable and when? In Sri Rama Multi Tech, it was held that interest on excess application money kept deposited in a separate bank account is available for adjusting any share issue expenditure. Hence, it is directly linked to PGBP. It is directly linked to PGBP. On the question, in which year we need to account. Now, please understand this. On the question, in which year we need to account for it. Suppose I issued the shares on March 1st. All allotment are completed on next year, April 30th. It will be accounted only not on accrual basis. Generally, interest on accrual basis, but this interest is not on accrual basis. Okay. Interest shall be recognized only in the year in which allotment is completed, because then only the money is unconditionally available to you. Then only the money is unconditionally available to you. So it shall be recognized only in the year in which allotment is complete. Take it down. Am I clear? Am I clear? Okay. So with this, we are putting a comma, not a full stop. Never a full stop till the last class. For the income discussion, which is under section 28. Okay. We will continue to see all these case laws, continue to discuss more on this as the class goes by. And going on to section 29, mode of computation of taxable business income. When I say business, I also mean profession. Please understand, when I say business, I also mean profession. Okay. Mode of computation of taxable business income. Okay, friends. Taxable business income is equal to revenue. That is income, which I told you is there in section 28 and 40. 41 is deemed income. Okay. Minus allowable expenses. Minus, the whole stress is on this word called allowable expenses. The whole stress of this chapter is on this words called allowable expenses. Okay, am I clear to you? The whole stress is going to be on this words called allowable expenses. Okay, allowable expenses is divided into three. Allowable expenses is divided into three, my dear friends. Okay, my dear friends, it is divided into three. Expressly allowed by law. Section 30 to 37. Section 30 to 37. Next, expressly disallowed by law. Section 40 and 48. Allowed only on the basis of actual payment. Section 43B. Friends, allowable expenses are divided into three. Expressly allowed by law 30 to 37. Expressly disallowed by law 40 and 40A. Allowed only if you make the actual payment, cash basis or within the due date basis payment. Okay, section 43B. That is so the entire focus or more weightage is given in this chapter on allowable expenses. On allowable expenses. Right? Friends, I'm going into the first heading of that. Okay. Expenses expressly allowed by law. Expenses expressly allowed by law. The lawmakers are preparing baskets. If you travel with their mindset, you will be able to understand the law in a better manner. Whenever they want to give deduction as a percentage of asset, they will make it fall under 32. Depreciation, additional depreciation. Previously, there was something known as investment allowance. Whenever they want to give asset itself as a deduction, they will make it fall under 35. Whenever they want to give asset itself as a deduction, they will make it fall under 35. Scientific research, specified business, agricultural extension program, skill development program. So it's baskets. That's what we are going to see. Expenses expressly allowed. The first three sections are for assets. 30, 31, 32 are for assets. In that 32, we are going to see separately. We will see section 30 and 31. Okay. So okay. Section 30, expenses in relation to building, and section 31, expenses in relation to the other assets, plant, machinery, and furniture. Rent, hire charges, current repairs and maintenance. Current means those which are not of capital nature. Those which are not of capital nature is known as current. Current year only the benefit is. That's what they mean by it. So these are all the expenditure which can be claimed for various assets, building, separate section 30, section 30, 31, plant, machinery and furniture. I have been always telling you, as part of our reading, we will also relate it to TDS. Somewhere again, when we read TDS, it will be better. This will come under, okay, section 194I. Okay, trust me. There has been a amendment 50,000 per month. From 2,40,000 per annum, they have raised it to a maximum sum of 50,000 per month. 194I. Interestingly, this is also section 194I. Okay, this is also section 1. Many people think higher charges are 194C. No, when you go to 194I and study, I will again repeat it, that any rent, interestingly, the rate is mapped with 194C, that is 2%. Let's see. Let's just now you note it down. We will do TDS, but it will be, when you revise, it will be easier to write. Am I clear? Okay, right. I'm going to the mother of all sections. Okay. Section 32, depreciation. Section 32, depreciation. Section 32, depreciation. Friends, what is this? What is this? Reduction in the value of asset due to wear and tear, usage, obsolescence, change in technology, lapse of time, effluxion of time. If you buy an asset, keep it for 6 months without using and sell it, still it is known as second hand. In all law, the depreciation definition is the same. Reduction in the value, and also in accounting. Reduction in the value of asset due to wear and tear, obsolescence and effluxion of time is the reason for depreciation. In our income tax law also, it is the same. Except this, no other place we match. Only the definition is common. In all other manner, All other laws compute depreciation in a particular way. Income tax law computes depreciation in a completely different manner. This is very interesting. The way income tax law is computing depreciation. Conditions for claiming depreciation. Conditions for claiming depreciation, four falling branches. Conditions for claiming depreciation. Okay, under income tax law, what are all the conditions for claim of depreciation? Okay, four falling branches. Right, friends? Right? Okay. It should be a it should be a friends specified asset. For claim of depreciation under income tax law, it should be a specified asset. It should be owned by assessee. The second condition is it should be owned by assessee. Sorry, I'll redo this table, please. Wait. For you, it will be branches. Okay, so it should be easy. It should be a specified asset. It should be owned by assessee. It should be used for purpose of business or profession. Only block of asset. Only block of asset method should be followed. Four conditions under income tax law for claiming depreciation. It should be a specified asset. It should be owned by the assessee, used for the purpose of business or profession, and we should only follow block of asset method. It should be a specified asset. Building, plant and machinery, furniture and fixture, intangibles. It should be a specified asset. The specified assets are building, plant and machinery, furniture and fixtures, intangibles. Non-specified assets, which means you cannot claim depreciation on them. Non-specified asset, which means you cannot claim depreciation. Land, goodwill, whether it is purchased goodwill or self-acquired goodwill, you cannot claim depreciation. Under income tax law, depreciation cannot be claimed for goodwill. Of course, in any law, for land, it should be owned by the assessee. Only the owner of the asset can claim benefit of depreciation. Only the owner of the asset can claim benefit of depreciation. In the case of lease transaction, only the lessor can claim. In the case of a lease transaction, only the lessor can claim the benefit of depreciation. Are you following? Are you clear? Clear? Okay, right. Okay, right. My dear friends, can a firm buy assets in their name? Unfortunately, it is not recognized. For example, shares. Can a firm be a member of a company? No, only it can be registered in the name of partner X, partner Y. So, asset might not be registered with the name of the firm, but it is in the name of the partner, but the firm would have funded it. The firm will be using the particular asset for their business or profession. But in the legal document, it will be the name of the partner. Sometimes companies also do that. Motor vehicles law require a natural human being mentioned. So company buys the asset in the name of the director. Company funds it. Company uses it. Now, how to? So came the concept of beneficial owner. It is not only the legal owner, it is who gets benefit out of it. In accountancy, you call it as substance over form. In accountancy, it is known as substance over form. In our tax law, beneficial ownership. Okay. The concept of beneficial ownership, okay, is superior. The one who funds and uses the asset can claim depreciation even if not registered under their name. The next condition is used for the purpose of to claim the benefit of depreciation. Asset should be used in the previous year. Very simple. And it should be used for business or profession. What does they technically try to make us understand? An asset used for personal purposes, depreciation cannot be claimed. Very correct understanding. If you are using the asset for personal purposes, you cannot claim the benefit of depreciation. As simple as that. Okay, very correct. To claim the benefit of asset should be used in the previous year. Now I ask you a question. I have a spare machinery. If my main machinery runs is unable to run, or if there is a problem, it stops, I will use my spare machinery. Last year, throughout the year, my main machine was running well. Throughout the last year, my main machine was running well. Will I still be able to claim depreciation on spare machinery because it's not used? Huh? I have in my office 48 hours power backup facility. After which, if power is not restored, I will use my generator. Throughout the last year, I never had a power cut which is extending beyond 48 hours. Will I be able to claim depreciation for my generator? I have not used? Yes. Yes. Usage can be active as well as passive. It need not be that. It should be actively used. Ready to use is a sufficient condition. Okay. Ready to use, you can claim depreciation. You can claim depreciation. Okay. Okay. The fourth condition is only block of asset method. Block means group. Block means group. Under income tax law, assets of similar nature having same rate will be grouped together. Depreciation will be claimed on group balance. Repeating, under income tax law, assets of same nature having same rate of depreciation will be grouped together. I have 25 cars in my company. Accounting standards, company generally accepted accounting practices, company law, car 1, make, registration number, opening WDV, depreciation, closing WDV, like that 25 line items. In income tax law, only one line item, block of car. Block of car. Companies like TCS, Infosys, TTS will have minimum of 1 lakh desktop and laptop computers put together. Desktop and laptop put together 1 lakh. Imagine generally accepted accounting and various other laws. One, nature of computer. What is the RAM? What is the unique code that is given to that? Opening balance, depreciation, closing balance, like that 1 lakh line item. Like that 1 lakh line item. Under income tax law, all the 1 lakh computers are together known as block of compute. What is it? Block of compute. Clear? Clear? Which is the biggest advantage. Block means group. Block means group. Under income tax law, assets of similar nature having same rate of depreciation will be grouped together and depreciation will be claimed on group balance. Under income tax law, assets of similar nature. Just because building and furniture both are 10%, can I group it? They are not similar. Having same rate of depreciation. I have a company bus which is eligible for 30%. Motor car which is eligible for 15%. Both are motor vehicles. Can I claim? No, they are not having same rate. It should be similar nature, having same rate, will be clubbed together, that is grouped together, and depreciation will be claimed only on the group. Refer note 1. For first one, refer note 1. Okay. And 2. Refer note 3. Refer note 4. Okay. Format to be format of work. Friends, note 1. You will be wondering, the 4 types of assets are building, plant and machinery, furniture and fixtures, intangible. What is this? Where is this car? Where is computers? In income tax law, according to section 43.3, according to section 43.3, plant includes scientific apparatus, surgical equipments, books, data processing equipment, nothing but computers, vehicles, land, ocean, and air, electrical fittings. Remember fan, air conditioners, lights, projector, camera are all plant. Note intangibles include know-how, patent, trademark, copyright. Intangibles include know-how, patent, trademark, copyright, other business or commercial rights. Okay, this is note 1 and note 2. For the first category, it should be a specified asset. Remember, goodwill is not a specified asset. Note 3, that is for use, it should be owned by the assessee. Friends, listen. There is this HUF called Sivakami and Co. They are into cabs, running cabs. But all vehicles are purchased in the name of the individual because HUF to a larger extent is not a recognized entity. Is not a recognized entity. So all assets are purchased in the name of the individual, but used by the HUF. Can depreciation be claimed by the HUF? EAO said, boss, no depreciation because assets are not registered in your name. Court said, who funded? Using the caps, they are earning income, no? Where it is recorded. Without an asset, how can they earn income? The source of earning income is asset. Without the asset, how can they earn income? So the HUF becomes the beneficial owner and they can claim the benefit of depreciation in A. Sivakami and Co. It is held that the beneficial owner can claim depreciation when asset and the income when the asset is funded by a person Income is also recorded in the books of a person. Even though the assets is not recorded in the or not registered in the name of such person, depreciation can be claimed by such person. This is known as the concept of beneficial ownership. This is known as the concept of beneficial ownership. Note 4, again a case law based. My dear friends, a lessor was there leasing vehicles to a lessee. In all type of lease transactions, at the end of the term, we are giving an option to lessee to buy the asset. In all type of lease transactions, at the end of the term, we are giving the option for the lessee to buy the asset. So what happens is, instead of dual registration, the assets is registered in the name of lessee itself, with the lessor having the right of repossession and inspection. Assessing officer said, boss, asset is registered in the name of lessee. Asset is used by lessee. Depreciation can only be claimed by the lessee and not lessor. Once more, asset is registered in the name of lessee. Asset is used by lessee. So, depreciation can only be claimed by lessee, not lessor. The Supreme Court said, no, you are wrong. The Supreme Court said, no, you are wrong. Registering the asset in the name of lessee is just to complete a formality or to avoid dual registration. The power of repossession, the power of inspection are strongly incorporated in the deed, which says lessor is the beneficial one. And the court asked the income tax department, what do you mean by lease? You using the asset or you using another person to use the asset, which is lease? Repeating. I am buying an asset, I am using it. That is not lease. I am funding an asset for another person to use it. That is what is known as lease. By giving the asset to lessee to use, lessor only uses it for his business, because his business is that. Repeating, by allowing the lessor to use the asset, it is lessee, by allowing the lessee to use the asset, it is lessor using the asset for his business, because his business itself is letting another person to use the asset. Following? Are you understanding? Okay, right? So, lease here, the law said, or the court said, okay, in ICDS Limited, it was held by the apex court, that is Supreme Court, that lessor can claim depreciation on leased asset as by giving it on lease, the lessor is using it for purpose of business. Registering the asset in the name of lessee will not change the claim of depreciation, as the power of inspection and repossession is strong. Am I clear? Now coming for format of working of depreciation. Format for working out depreciation. What is that? Block of asset method. That is, assets of similar nature having same rate of depreciation will be grouped together and depreciation will be claimed on the group. Block of asset method. Block of asset method. First, opening WDV as on 1st April 25. For all of us, we are doing for financial year 25-26. So 1st April 25. Additions. Asset purchased during the year. Put to use for 180 days or more. Put to use for less than 180 days. Deletions. Sale value of any asset pertaining to the block. balance available for depreciation less depreciation less depreciation normal additional I will make you understand every term, every term of it. I will make you understand. You will become stronger and stronger in depreciation in the next class. I assure you that. But as of now, preceding year's closing balance is current year's opening balance. Once more repeating. Closing WDV as on 31st March 25 can only be the opening WDV as on 1st April 20. Additions are bifurcated into two. Put to use for 180 days or more, approximately October 3rd will be the date. October 3rd will be the date. Put to use for 180 days or more, I can claim full depreciation. If it is 15%, 15%. If it is 40%, 40%. Put to use for less than 180 days, which means after October 3rd, I'll tell you how it comes little later. I will be able to claim only half of the eligible depreciation. In income tax law, there is no concept called proportionate depreciation. That is, in accountancy, if you buy an asset on 1st of July, asset value into rate into 9 by 12. 1st of September into 7 by 12. 1st of Jan into 3 by 12. 31st of March into 1 by 365. Under income tax law, if you buy before October 3rd, claim fully the depreciation. If you purchase and put to an asset into use after October 4th, even on 31st March, you start using the asset, you can claim half of the eligible depreciation. That's what is this computation. Am I clear? Am I clear? Okay. The full sale value will be reduced. On sale value, no depreciation. This is the crucial point for claiming depreciation. Balance available for depreciation. This is the crucial point. On this balance only, I can claim depreciation. Normal, additional, we'll see later. And then the closing WD. Just look into the format. Just look into the format. Give me a moment. Friends, let's get our hands wet with doing one question. Let's just understand one question. Then I'm going to take full class, 1.5 classes also of depreciation. First, let's get into a practical question on depreciation. Assessee gives the following particulars of his asset. Practical question, page number 2. Question number 2. Compute admissible depreciation, plant and machinery, motor car, opening balances, furniture, books, computers. Addition, furniture, first half, second half, computers, second half, motor car, 1st of October. So, first half only. Generator, first off, not at all used in the office as they had a power backup, no issues. Sales, furniture, and we'll come to this books later. You read through. If I look at it, plant and machinery, motor car, furniture, books, computer, generator, 6 blocks all day. 6 blocks. Every similar asset is only. No, don't see the rate. Is it a similar asset? Generator and machinery are not similar assets. Motor car and machinery are not similar assets. Computers and books are not similar assets. So it should be a similar asset. For our working, I will divide it into 3 and 3 or 3 and 2. Books alone, please wait. Let's start working. Books alone, please. Only motor car. There is no plant and machinery, but there's furniture. Furniture is there, 16 for 10. Furniture is sold for 16,500. My dear friends, here nothing, 23 lakh 40,000. Here 18,900. Okay. Here, please understand 16,410 into 5% plus 6 lakh 49,010 minus 16,410 into 10%. Repeating, this asset is purchased late, so 5% can only be claimed. And on the balance, what is balance? 6,49,010, and for 16,410 I have claimed. Friends, these are all the answers at the first level for these three assets. Just check it out. Start working the other two. Start working the other two. Don't do for books. I want you to do for leave book, computers and generators. Start working. Computers and generators. Start working. Start working. Start working. Friends, computers 72,140, and I have purchased the computer on 11th November, less than 180 days. So 1,84,300 into 20% plus 2,56,440 minus 184,300 into 40%. Got it? Let's go forward. Let's go forward. When does a block cease to exist, goes out of existence? My dear friends, in what circumstances a block goes out of existence? Okay, in what circumstance a block goes out of cease to exist? In two circumstances, a block cease to exist. One, when all the assets in the block are transferred. When all the assets in the block are transferred, the block goes out of existence. Everything is gone. When the sale consideration exceeds the balance available in the block. When the sale value, suppose in this case, the old motor car 72 or the old computer 72,140 is sold for 2,70,000. Random example only I am giving you. Even though there will be a computer, the block has gone out. In two circumstances, it goes out of existence. It goes out of existence. According to section 50, which means we have gone to the next chapter, capital gains, because 44, it stops here. According to the resulting gain or loss is always short term. According to section 50, okay, according to section 50, the resulting loss or gain is always short term. Okay, the resulting loss or gain is always short term. Now, in the given question, okay, you can see in the given question, my dear friends, all the available books are sold. All the books are sold. Hence, the block has gone out of existence. Hence, the block has gone out of existence. What is the opening WDV of books? 81,310. All are sold for 26,000. Short term capital loss. Do you understand? All the books are sold. Notes. Total depreciation. Total depreciation. My dear friends, what is the total depreciation we are getting? 3,51,000 plus 288,750 plus 64,081 plus 65,716 plus 8850. 7,78,397. Total depreciation 7,78,397. Note 2, which is very important. Okay, assessee is eligible to claim depreciation on generator even if it is not put to use. Okay, even if it is not used. The term put to use means ready to use. Am I clear? Am I clear? We wind up here. Tomorrow's session is full of depreciation. Meet you in the next class. All the best, friends.